Let's find out how all these pieces fit together now with ECU Group's Head of Investment, Philip Manduca. Philip, pleasure to have you on the programme. So if we start off with bonds, just looking at what the Fed did 6 weeks ago to buy these, buying bonds, it was controversial when they did it at the time, but we're now seeing long-term interest rates up again. So did that have the effect that it was supposed to have?
Well, clearly not. Bernanke believes that QE2 or QE itself will reduce bond yields. That's what he wanted. Quite the reverse has happened. You've seen a 130 basis point move since it was intimated at the Jackson Hole speech. That's the reverse of what he wanted. And you've got to ask yourself why. Why are bond yields rising like this?
Indeed, and why are they?
Well, forecasters, investment banks in a self-serving manner are talking about, of course, to do with the fact that economic growth in 2011 will be better and bond yields are beginning to reflect that. Doesn't wash with me. There's also a belief that the Fed's going to lose control of this money printing process and we're going to get monetization, possibly, but I'm not seeing it in TIPS yields being reflected there. No, I think it has to do much more with a debt equation that's going on and the fact that there's a real concern out there that this debt story is getting out of control. And I do believe, sincerely, that there'd be significantly more pressure on the US right now than there currently is if there wasn't a European problem, which, of course, is more paramount and more immediate.
Right. So, I mean, there is also the argument, though, that yields did go up at the end of 2009. Is this a kind of a year-end thing? Is this maybe being a little bit overblown? What do you think of that?
Well, it is the hope of the bond bulls that this is a seasonal technicality. It has something to do with Build America-type bonds in the muni market that's going on. I don't believe so. I think that this has got something more to do with the fact that systemic fears are increasing generally, and I think that higher bond yields are reflecting that, and I think that they will continue to reflect that into 2011, creating a tipping point for equities, which just cannot withstand the pressure of higher bond rates, particularly as it applies, in fact, to the consumer via the housing market, via the potential for loan rates and refinancing rates in 2011.
Because, so far we've seen such a sustained run, really, on equities. And that seems to be almost across the board. We've seen what's happened with China, and we've got another little surge this morning. You don't think that that's sustainable? What is the tipping point? Where do bond yields start to impact on equities?
Imminently ahead. I think that you've got, within the next 8 weeks, you will see a peak in equity prices, and you will see a move at least 10 to 15% lower over the course of the next 3 months. So that's quite a call there. But I do believe that equities are, at this moment in time, running on no gas at all, and purely on goodwill, purely on optimism. Everywhere you go, everybody is telling you what a bull market equity is going to be in 2011. Just on a contrarian play, I'd bet against it.
And that's despite the kind of corporate earnings that we're seeing, which have actually been very strong.
The corporate earnings have been good, and of course the global growth story continues, and that's why you're not seeing more pressure being put on China for the fact that they haven't pushed their exchange rate higher since the G20 meeting. It hasn't moved at all, and why the Chinese are rejecting the move which is necessary to get interest rates up. You've got food price inflation in China at this moment in time, and that's on an official basis at 11.5%. God knows what it is on an unofficial basis. They've got a real inflation problem, and of course that's why I've been so bullish of gold generally, but more immediately ahead, I'm bullish of the dollar, because I do think the dollar benefits from these higher rates in the very short term.
Well, let's talk a little bit more about the dollar, because of course when Ben Bernanke brought in QE2, there was a concern that this was effectively a way of devaluing the dollar. We would have expected to see the dollar going down. That hasn't really happened. Is that all about what's happening in Europe, or why is
QE2 hasn't worked. That's why the dollar isn't going down. I have no doubt that everybody wants their currency weak at this moment in time, because exports to Asia and emerging markets is the only growth story around, given a tapped-out consumer that isn't getting any wage increases. No, I think the story really, as regards the dollar, is it's going to be one of rates in the meantime, and refuge, and year-end, and of course there's a better growth story being forecast for the United States. So in the short term, I expect this dollar strength to continue, and could see maybe another 5% or so of dollar strength before, again, the dollar tips over by the end of the first quarter 2011.
So when you say in the short term, are you talking about that kind of 8-week period?
Yes, I think over the course of the next 4 to 8 weeks, you get equities tipping over, you get the dollar continuing to be a bit stronger going into the end of the first quarter. That's how I see it, but ultimately this is going to come from a function of higher interest rates at the intermediate and long end of the bond curves, and ultimately higher interest rates in China, which are going to continue to lag their rising inflation rate.
Well, let's talk a little bit more about China, because, of course, we've seen this move over the weekend. I mean, really, what China does or doesn't do is pivotal for elsewhere, right?
Well, it's the macro story. You can talk about at the margin what's going on in Europe and the US, but as you saw in 2010, all risk managers, including us, had risk far too tight. We didn't really do very much. Nothing really happened, generally speaking, in terms of price movement from January the 1st to now. But what the story really is in China, and again, you've got to keep coming back to this growth story there of inflation. Inflation is very much, in my opinion, a 1970s-style Western phenomenon. You're going to see it continue to be higher than interest rates because they're going to try, in an imbalanced economy, to defend against a stronger exchange rate. So interest rates will lag the inflation rate. The inflation rate will keep rising. You're going to see inflation in China moving out of control in 2011, causing a reaction, I think, from the Chinese authorities, who, of course, are very sensitive to food prices in China.
Yes, indeed. And that reaction would be to hike interest rates?
They'll have to at some point. And, of course, this, again, will create what I think is this tipping point in the first quarter 2011. Food prices are going to continue to rise. I know the forecasts are out there that the seasonal effects will be working their way through and food prices will begin to decline. I don't believe it. And I don't believe it because Chinese wage rates are on an upward spiral and they are going to continue to keep going higher. And they're going to continue to demand going higher. And this is going to cause more and more wage pressures and, of course, price pressures in China, just as we had in the 1970s in the UK and Europe and the US.
If you don't mind me saying so, you're painting quite a volatile and rather worrying picture. Does this mean that gold is going to be a safe haven?
Well, the problem I've got with gold right now is I think that gold gets contaminated by what I expect to happen in equities, and I think that you will get a sell-all situation in the first quarter where all things that have gone up will be liquidated to repair losses elsewhere, and I think gold and silver get caught up in that. You then get yourself to a point, are you really bullish about gold and silver, or have we seen the peak? I remain very bullish of gold and silver for as long as it takes the Chinese to get interest rates above inflation. I don't expect that to happen anytime soon. So the next sell-off in gold and silver, and I am looking for one at this moment in time, will create another buying opportunity in a multi-year bull market in gold, which will take us through to 2000, which, as you know, has been my long-held prediction.
OK. Thank you very much indeed, Philip Manduca, for joining me. Thank you.